Guys, this is Anurag Sharma, and today I'll be discussing with you balance of payment. What is balance of payment, guys? It is a very important concept, and in this particular lesson, I'll be discussing with you the basic concept of balance of payment. It is also known as BOP. So, a BOP refers to the recording of all the economic transactions of a given country with the rest of the world. So, see, guys, what is balance of payment? Like an ordinary trader, like an ordinary businessman, each country has to work out a balance in respects of its dealings, in various items. A country exports and imports. So basically balance of payment is a statement that summarizes an economy's transaction with the rest of the world for a specific time period. So it signifies the characteristics of a balance of payment. That what is balance of payment? It is a statement of a country which summarizes an economy's transaction with the rest of the world for a specific time period, and it is also known as balance of international payment. So a country has to deal with with other countries in respect of the following three items. These three items are either exported or imported. These are the various three items in which a country deal with the rest of the world. The first item is visible item. It deals with the physical goods exported and imported. Like wheat is export, we India export wheat, and crude oil is importing. So these items come under visible items. Then comes invisible items. Invisible items like export and import of services, various type of services, workers remittances, insurance services, these type of services, these invisible items. And the last but definitely not the least item is capital transfer, and it these capital receipts and payments like investment by foreigners in India, and payments made by Indians to foreign countries. These type of transfer known as capital transfer. So basically, I believe that you're getting an idea, like like just an ordinary businessman, he maintains his account, from wherever his money is coming and wherever he's spending his money. So he's maintaining a statement. When a country does that, that statement is known as balance of payment. So all trades conducted by both the private and public sector are accounted for in BOP, and in order to determine how much money is going in and out of a country. So it's not only related to government expenditure or public sector expenditure, it includes both private and public sectors are accounted for the balance of payment. And if a country has received money, it is known as credit, and if country has made payment, then its transaction is known as debit. So this is the basic general idea of balance of payment. So in a nutshell, we can say that balance of payment and international investment position data are very critical while formulating national and international economic policies. There are certain aspects which in which balance of payment data such as payment imbalances and FDI are key issues that a nation's economic policies seek to address. So it is a very important statement, on the basis of which the foreign policy is decided, on the basis of which foreign direct investment policies is or are formulated. So now question arises that what are the various forms of balance of payment, or how many types of balance of payment, or what is the structure of balance of payment. So balance of payment basically can be broken into three categories: balance of payment on the basis of current account, on the basis of capital account, and on the basis of financial account. So it should be, I'll just remember that the current account should be balanced on the basis of capital account and financial account. We'll discuss what is the balance of payment on the basis of current account. Simple saying, guys, that balance of payment on current account basis is the, this equation is explaining, visible plus invisible exports minus visible plus invisible imports. So simple definition, that whatever the exports and imports are going through, whether it is of visible items or invisible item, which I've discussed in the previous slides, that difference is known as the balance of payment on the basis of current account. Very important, guys, while calculating the what is the position of balance of payment, whether it is favorable or unfavorable, that is somehow is most of it depends upon the BOP on current account. Then comes BOP on the basis of capital account, and it is basically refers to all the financial transaction, and it includes foreign investment and external loans. When investments are coming in or investments are going out, or loans are we are taking loan from other countries. So these are all these type of transactions come under capital account, and all transactions under capital accounts are concerned mainly with financial transfer between our country and other foreign countries. So just basically only financial transactions are comes under capital account, and that BOP is known as BOP on the basis of capital account. Then comes financial account, BOP on the basis of financial account. So it is a financial account and international monetary flows related to investment in business, real estate, bonds and stocks are documentation. So these type of documentation comes under financial account. It includes government owned assets such as foreign reserves, gold, SDRs, special drawing rights with the International Monetary Fund, private assets held abroad, and for foreign direct investment. These type of transactions come, these not these type of transaction, documentation of these type of transactions comes under financial accounting. And assets owned by foreigners, private and officials are also recorded in the financial account. So these three items or these three categories comes under the balance of payment. Now the balancing act of BOP, the most important concept, that why we are studying balance of payment, because we need to see this balancing act of balance of payment. So basically current account should be balanced against combined capital and financial account. The ideal situation is that the current account should balance between the capital account and the financial account, but it is a very rare phenomena, and it should be the ideal situation is that the balance of payment should be in equilibrium. In a simple language, that receipts should be equal to the payment, but it is a very rare phenomena and it rarely happens, and this equilibrium may be sometimes on minus sides or sometimes it may be on plus sides. On minus side it is known as deficit, and on plus side it is known as surplus. So whenever there is a disequilibrium on minus side, so we will say that balance of payment is on deficit side, and whenever there is equilibrium on the on favorable side, that is on plus side, then that balance of payment is known as surplus balance of payment. It is explained in the following slide. Favorable balance of payment: when receipts are more than payments, then balance of payment turns favorable, and symbolically it is explained with this formula, that BF is balance favorable, R stands for receipts, P stands for payments, and it should be greater than 0. So this particular situation here, guys, known as favorable balance of payment. Receipts and payments, the difference between receipts and payment, it should be greater than 0. So that particular phenomena or that particular situation is known as favorable balance of payment. Then comes unfavorable balance of payment. So it is exactly opposite of the favorable balance of payment. So when receipts are less and payments are more, means we are paying more but we are receiving less. So definitely the balance of payment will shift towards the negative side, and the difference between receipts and payment will be less than 0, and that balance of payment is known as unfavorable balance of payment. Now let's talk about the ideal situation, which rarely happens. It is very difficult and almost impossible phenomena that there is an equilibrium in balance of payment. What we should understand, that what is equilibrium in balance of payment. So whenever the capital receipts of a country and exports, whether it is of visible items and invisible items, are equal to its capital payments and imports, whether visible and invisible, then its balance of payment is in equilibrium. And this formula explains that what is equilibrium in balance of payment. In this particular situation, the receipts and payments are equal, so their difference also becomes 0. So that phenomena is known as equilibrium in balance of payment. So guys, this is basic understanding of balance of payment. It is very important phenomena because India is a growing economy, and we export so many things, we import so many things, and there is always an imbalance between the import and export, receipt and payment of goods. So we should know that how these things are arranged, how these statements are made. So this is all about balance of payment. If you have any doubt, kindly give your valuable feedback and review. I'm waiting for that. Happy learning. This is presented by me, Anurag Sharma.